All right. Well, welcome everybody. It's a pleasure to be here today for the first time with Idea to IPO organization. My name is Andrew Godfrey, and I am with CliftonLarsonAllen or CLA. And I'm here today to discuss a fun and exciting topic called Startup Valuation Workshop. What is your startup worth? Next slide is just a disclaimer and won't bore the audience by reading it, but wanted to put it up on screen here. I do want to first give a brief overview of CLA and our capabilities as a professional services firm. And put simply, CLA exists to create opportunities for our clients, our people, and our communities. And we do this through industry-focused solutions such as digital, audit, tax, consulting, wealth advisory, and various outsourcing type services. And we do this when we live out the CLA promise, which is to know you and to help you. And we've done this with a number of companies over the years, serving approximately 200,000 plus clients across our 130 locations and 9,000 professionals that we have as part of the firm. And as mentioned, CLA is an industry-focused professional services firm, and we have partnered with a number of early-stage companies in the technology and life sciences industries by helping them move strategically through the phase of the startup life cycle through services such as finding seed and growth capital resources or maximizing available credits and incentives from a tax perspective, even developing and helping to develop equity incentive plans, and of course, providing valuations, oftentimes from a 409A valuation perspective. And I will say this, we've also developed a really neat resource that I think is really beneficial for startups and their founders, and that's called the CLA Startup Academy. And I have the link over here for it. But this was created because we know in the early stages of your business, you're oftentimes focused on creating a viable product, finding talent, securing funding, and among many others, right? And this CLA Startup Academy was really created to provide these startups with brief video courses covering topics that are really relevant for every startup or early stage company, and really focuses on things such as accounting and payroll and tax, but it also goes into an overview of the fundraising process and the investment process. So if you're interested, and afterward, once I provide the slide deck out to this group, feel free to click this link here, and hopefully you'll find some great resources from it. And lastly, I'll just give a brief overview of myself. I have approximately 10 years of experience across valuation and corporate development, working with early stage to mature companies across a variety of industries, and have performed valuations for Internal Revenue Code 409A, financial reporting, and other tax purposes. And I hold the accredited in business valuation credential that's issued by the AICPA, and attended my undergraduate studies at the Indiana University Kelley School of Business. So diving more into the content, today we'll explore the purpose of a 409A valuation and why privately held companies often obtain 409A valuations. We'll then briefly highlight some key characteristics and stages of early stage enterprises, as this can oftentimes dictate the approach used to value early stage companies and startups. We'll also dive a little bit into the current venture capital environment and how VCs and investors are currently viewing early stage company valuations. Next, we'll get into some valuation methodologies that are often used for startups. Those could include the income, the market, and asset or cost approaches. And we'll also touch on the venture capital method as well. and then we'll finally wrap it up with an overview of equity allocation methods and their appropriate use cases. So diving into 409A valuations, I think it's really important first to understand the standard of value that Internal Revenue Code 409A valuations are held to. And this standard of value is called fair market value. And what fair market value is it's the most common standard of value used for valuations. And it is very similar to the definition of fair value, which is the standard of value oftentimes used for things such as financial reporting or equity-based compensation type requirements. But fair market value is defined by the IRS as the price at which property would change hands between a willing buyer and a willing seller, neither under compulsion, both having reasonable knowledge of relevant facts. So to put it more into layman's terms, in a simple example of fair market value could be, you're looking to sell your iPhone, right? A lot of people have iPhones or some cellular device, and you check websites like eBay or Facebook Marketplace, and you see that similar phones in the same condition are selling around $400, right? You then list your phone for $400, and a buyer who has been looking for that model agrees to pay that price, right? Neither of you are in a rush, and both of you know what that phone is truly worth. And that $400 price is representative of the fair market value. So it's a well-informed buyer and what they're willing to pay, and what a well-informed seller is ultimately willing to accept. So getting into 409A and the 409A valuation in the overview, really, it's in the early stage company and startup world, the most common type of valuation you'll hear is a 409A valuation. And what a 409A valuation is it's an independent appraisal of the fair market value of a private company's common stock. And 409A is a section within the Internal Revenue Code that requires that stock options be issued at or above the fair market value of equity of the company. And it's oftentimes expressed on a per share basis to determine the common stock. And Internal Revenue Code 409A was enacted and really effective back in 2005 and was really introduced largely in response to corporate scandals like Enron, where executives manipulated deferred compensation plans to their advantage before the company actually collapsed. But really the goal of 409A was to increase transparency and prevent tax avoidance through improper deferral of compensation to employees and of course the executives. So given the IRS scrutiny of stock-based compensation and the other deferred comp arrangements, the IRS highly suggests that companies obtain a qualified independent appraisal to perform their 409A valuations. And the IRS even adopted what's called a safe harbor program, which provides a level of protection to companies and its employees to avoid the IRS knocking on your door for improper stock option issuance. And I'll get into the 409A safe harbor on this next slide here. So this 409A safe harbor concept, it's a legal protection that ultimately shifts the burden of proof back to the IRS if they challenge your company's 409A valuation. So in other words, if you meet the safe harbor requirements in the eyes of the IRS, your company's valuation is presumed reasonable, and the IRS must come back and prove it is grossly unreasonable to impose penalties. So in order to meet these safe harbor requirements in the eyes of the IRS, a company must use one of the following IRS approved methods. And these include an independent appraisal by a valuation professional, or the illiquid startup method, or this binding formula method. And I'll touch briefly on the last two here, but the illiquid startup method is used. It must be performed by someone with significant valuation knowledge or experience. Very similar to having an independent appraisal done. And a lot of times the work involved can be significant. And lastly, the binding formula method is, I'd say, rarely used, as it's really not suitable for most startups or high growth early stage companies. So if you're wanting the legal protection that the 409A safe harbor provides, I would highly suggest engaging with an independent valuation professional with the knowledge and experience of valuing early stage companies and certainly privately held companies for 409A purposes. In practice, I would say valuations that are performed by independent third parties are less likely to be challenged by the IRS. And it's really because these valuations will be subject to valuation standards and methodologies, right, that are widely accepted and have oftentimes been seen by the IRS. And additionally, and as I mentioned previously, these valuations are assumed reasonable, and the IRS must prove the valuation is grossly unreasonable to impose penalties. So valuations that are most commonly challenged by the IRS are ones that are not protected by this 409A safe harbor. And these challenge valuations can result in, I'd say, fairly severe penalties to the employee and potentially the company. So it can include penalties on the entire vested amount, and it becomes immediately taxable, even if the compensation's not yet paid out, right? There could be a 20% federal excise tax in addition to the regular income tax. There could be an additional interest charge levied upon you with the interest rate charges. And then, of course, state level tax penalties as well. So these are all just things to consider as you approach, hey, look, I'm looking to issue stock options to my employees, right? And what's the best way I can do this that would protect myself and the company and the employees, right? And I would just highly suggest at least considering looking at an independent appraisal, from a valuation professional. So now diving into some of the characteristics of early stage companies, right? I know a lot of the audience here today, these are probably not new to you, but they can certainly have an impact on the types of valuation methods that are ultimately utilized, right? So some key characteristics, right? Minimal or no revenue, right? So some early stage companies or startups have limited revenue or minimal revenue depending on its stage of development. They also could have a limited expense history and may not have a full management team in place yet. And the business is really centered around more of an idea or a plan and possibly some initial product development or prototyping. There could be high risk and uncertainty, right? Early stage companies oftentimes have significant uncertainty and risk regarding the company's ability to develop a product or find product market fit and ultimately then achieve commercial success. But if these companies are, of course, ultimately successful, it can result in extraordinary returns to equity holders, of course. And lastly, early stage companies oftentimes have and look to venture capital investors or family and friends or outside investors, right? And they go through rounds of financing. With each round oftentimes just providing enough funds or capital to reach a targeted milestone or a stage of development. And these companies also I'd say oftentimes have complex capital structures. So it could include instruments such as preferred stock or options and warrants that can actually end up having a dilutive impact on the common stock of the company down the road. I also wanted to highlight kind of the current state of the venture capital market and a few trends that we've seen as it pertains to startup company valuations as well as deal activity in today's environment. And when it comes to companies in the seed stage, we've seen that overall deal volume and capital raised declined pretty significantly, with the number of closed seed rounds declining almost 30% year over year. But however, the median pre-money valuations of these same seed stage companies has actually increased 20% year over year. This is very, very similar to Series A companies as well, where that deal count and total capital raised declined year over year, although to a lesser extent compared to the seed companies. And it's really just reinforcing the trend of fewer but larger, higher valued rounds, right? Some other key items I wanted to highlight, though, is that the total capital raised declined about 3% from Q1 of last year, but quarter over quarter deal count dropped about 33% compared to Q4 of 2024. And part of this is just, of course, cyclicality, right? When investors ultimately close rounds, which oftentimes occur in the back half of the year, but it is also highlights maybe that sharp contraction in investor activity, which is also fed into more, unfortunately, down rounds, right? And overall, the percentage of down rounds has continued to rise, which of course is indicating ongoing valuation pressure and market correction that began, in prior quarters. And the last thing I'll highlight, just as it pertains to seed activity, is that approximately 50% of all seed stage activity has come in the form of bridge rounds. So this could be in the form of convertible notes, safe instruments, add-on investments that really aren't priced rounds, but what it's signaling is that startups are extending or needing to extend their cash runway rather than going out and receiving priced equity rounds. So now kind of getting more into the valuation methods, I think maybe before we jump directly into that, I think it's really important to understand the concept of time value of money, right? And it's a concept that I think is maybe widely understood, but I think it's good to maybe reframe it in terms of an example, right? So imagine that you had $100 today, right? You had that $100, you could invest it and earn a rate of interest, right? You could go and buy something now before prices end up rising, or you could lend that $100 and earn a return, right? Similar to if you invest and earn interest. So, or if you wait a year to receive that $100, you would miss out on all those opportunities, right? So the time value of money premise or concept is really, it's a critical concept to understand when determining the value of a company or an interest within a company. So we'll discuss more about that as we walk through the various approaches here to valuation. So on the slide here is just the methods that we'll ultimately walk through. The first being the income approach, and specifically the discounted cash flow method. Then within the market approach, we'll discuss some guideline company or public company method, guideline transaction method, and the back solve method. And then we'll briefly touch on the cost approach and then wrap it up with the venture capital method. So the discounted cash flow method is really, it's a core technique under what's called the income approach. And it's to value and estimate the present value of a business by projecting its future expected cash flows and then discounting them back to today, to present value, using a risk-adjusted discount rate. So the key steps in applying this discounted cash flow or DCF method is first forecasting the business's future cash flows. So that could include estimating the company's expected cash flows over a discrete forecast period. It could be, 3 years, 5 years, 7 years. Oftentimes, these are based on business plans or looking at, a market analysis and even management input, right? So for these early stage companies, revenue growth can oftentimes mirror that hockey stick type growth, when the company achieves commercialization of its product. Now, one thing I'll mention, and it's hard even for mature companies to, no forecast is ever perfect. There's always some level of subjectivity, right? And uncertainty that goes into there, right? And so that's where we try to factor in things like taking into account either a risk-adjusted discount rate or adjusting the cash flows, which I'll get to here in a sec. So once you have your forecast, your cash flow forecast prepared, that next step is estimating the value of the business beyond that discrete period. So that 3 to 5 to 7 year period, there's value beyond that, right? And this is often done by using what's called a terminal growth rate, that reflects long-term inflation and industry growth rate expectations, or oftentimes for early stage companies, it's more of an exit multiple, which could be based on a financial metric such as revenue or EBITDA, right? So once that terminal value is estimated, the next step would be to estimate a discount rate that reflects the riskiness of the projected cash flows. And this oftentimes is a weighted average cost of capital, or maybe you've heard it coined as a WACC, and that's more for mature companies, right? However, for early stage companies, this rate is typically much higher to reflect the greater risk, right? Which I'll discuss in more detail on the next slide. So once the discount rate is estimated, right, the next step is to calculate the present value of that discrete cash flow period, again, that 3, 5, 7-year period, and that terminal value, and that estimates the enterprise value of the company. And really the enterprise value of the company is just simply the company's fair market value of its debt and its equity. And then to get to the equity value, the final step would be to adjust for any debt and other non-equity claims to arrive at the equity value of the company. So really the DCF method, I would say, is most relevant for early stage companies that have a developed product and can produce a somewhat credible forecast, right? Even if the forecast is highly uncertain. So for early stage or pre-revenue companies, the DCF method may be less reliable, and maybe the cost approach or that back solve method, which we'll get to here in a sec, or any recent financing transactions might be more appropriate, right? But these high discount rates are often applied to early stage companies to reflect the high risk and uncertainty associated with those forecasted cash flows. So the discount rates can often range from 20% all the way up to 60, 70%, really based on the stage of development of the company, right? And to determine an appropriate discount rate for these companies, what valuation professionals oftentimes review are average rates of returns for various types of venture capital funds, as well as studies performed for individual venture investments, which are oftentimes based on historical studies. An alternative approach to incorporating the risk in the business is to adjust the risk directly in the cash flows instead of the discount rate. And this can be done by modeling multiple cash flow forecast scenarios, which could include a success scenario, a partial success scenario, maybe a failure scenario. And then what you can do is you can probability weight those outcomes. And the ultimate discount rate that is then applied to these probability weighted outcomes or cash flows would ultimately be less than applying a discount rate to a single cash flow stream. As again, we are attempting to incorporate the risk directly in those probability weighted cash flows instead of just the discount rate. And another observation when valuing early stage companies under the income approach is that a large portion of the value is subsumed into that terminal value, right? So we talked about that discrete period, that discrete forecast period that you try to estimate, but the majority of the value is really in that terminal value or beyond that discrete period. And that's because oftentimes early stage companies, their cash flows are either negative or minimal in that discrete period, right? The value is really what you're going to be doing kind of after that period. So at the end of the day, I'll say this is calibration is key. So if any type of calibration can be performed, the resulting value under the income approach really should never be looked at in a vacuum. And I'd say it should be compared against any relevant recent or observable transactions that might have occurred in the market, or even looking at market multiples as well. And the one thing I'll put up here is just more as a visual, is just kind of an idea as to what a discounted cash flow model would look like, right? And this specific example here is more that probability weighted cash flow scenario that I was discussing, where you try to adjust the cash flows for the probability of achievement of those cash flows, and then you could potentially apply a lower discount rate, right? And so in this scenario here, you'll see the optimistic, realistic, and pessimistic is what we called the scenarios in this example here, right? And a forecast was prepared, this one certainly beyond 7 years in this case, right? But you can see certainly those earlier stage or earlier years in the discrete period, they have those negative cash flows, right? And over time, that certainly increases. But at the end of the day, it's applying really an execution probability to those cash flows, right? And once you're able to apply those, you apply that present value factor that includes that discount rate that is selected, and then the sum of the present value of those discrete cash flows is summed, right? Well, that's that discrete period. Then you get to your terminal value, which is the value beyond 2023 that's not being forecasted in this scenario. So in that case, what we did in this case was looking at a present value of the terminal value using an exit multiple instead of a Gordon growth model or a normalized, I'd say, inflationary growth rate. And so applying this revenue multiple to the last discrete period's revenue, and then also present valuing that back to today, gets you the value or the present value of your terminal value. And then from there, as I mentioned, you make certain adjustments. In this case, we added back cash and deducted the debt that was outstanding to arrive at the fair market value of equity of this example. So next, I'll go into the market approach, in this case, the guideline public company method. And really, this is a market-based valuation method that estimates the value of a company by comparing it to publicly traded companies, or oftentimes called guideline companies, that are similar in terms of industry, business model, growth, and potentially risk profile. And really, the core idea is that the market prices of comparable public companies can provide a reference point for valuing the subject privately held company. And the first step in applying the guideline public company method is to select the public companies that are as similar or as possible to the subject company in terms of industry or product, services, stage of development, growth prospects. Could include profitability or even, certainly risk. So once those guideline companies are determined and developed, you can then calculate and select the valuation multiple. So these valuation multiples could include enterprise value to revenue or enterprise value to EBITDA, could even be price to earnings if there really are earnings. But ultimately, these valuation multiples are calculated using the market prices and the financial data of those guideline public companies as of the date that we are valuing that company. So once those valuation multiples are calculated and ultimately selected, then you need to consider certain adjustments for differences in size and growth and profitability and risk, right, between the guideline companies and the subject company, right? So those guideline public companies, they're oftentimes larger, right? So there are certain factors, right, with being a larger company or having a proven concept out in the market that might warrant a certain adjustment to the subject company multiple that you're ultimately selecting. Now, once that's selected, right, the selected multiples are then applied to the selected financial metric of the subject company to estimate its enterprise value. I'll briefly touch here on the transaction method. It is very similar to the guideline public company method, although the guideline transaction method is more a market-based valuation approach that estimates the value of a company by referencing pricing multiples that are derived from transactions, right? Some recent mergers, acquisition, could even be private transactions involving the companies that are similar to the subject company, right? And so again, kind of that first step is finding recent transactions, right? Relevant transactions, that could be applicable to the subject company, right? So again, looking at things like industry and business model and growth and risk profile, right? So once you get there, then you take that same approach of calculating and selecting that valuation multiple. Again, it could be an enterprise value to revenue, enterprise value to EBITDA, price to earnings, right? And then once that's applied, right, then you need to adjust that multiple for the same considerations that you do under the guideline public company method. And then again, once that's selected, the selected multiples are then applied to the financial metric to determine the ultimate enterprise value. So the back solve method, I think this is the method that is most often used by valuation professionals if there has been a recent financing transaction that has occurred in the company. So really, the first step in performing the back solve method is identifying a recent arm's length transaction in the company's equity. So this could be preferred stock, typically a preferred stock financing round. And the emphasis here is that the transaction needs to represent an arm's length transaction with a willing buyer and a willing seller, and oftentimes includes new investors to the company, right? So once you've identified if there is a transaction that can be determined to be arm's length, you need to then build a valuation model, right? And oftentimes the model that is used in the back solve method is some type of option pricing model or scenario-based model that reflects the rights and the preferences of all the share classes, right? So once that valuation model is selected, then you need to develop the inputs and observable and supportable assumptions, right? And some of the key assumptions that go into the back solve method, and I'll say oftentimes the option pricing method, is a time to exit, right? When you expect there to be a liquidation event, right? It could, and then the next could be volatility, right? Volatility of the company's equity, which can oftentimes be based on those same guideline companies that we just discussed in the market approach. And we can look back over the expected time to an exit and say, well, over that time period, what has the volatility of the company's equity for those guideline companies been, right? It can be a benchmark as an input into the analysis. And then, of course, factoring in the company's own capital structure and any liquidation preferences associated with the preferred stock, right? And once these assumptions are inputted, you can then back solve what equity value would equate your recently transacted shares to the original issue price. And I'll show an example here in a sec, but you are ultimately able to determine what that equity value is that gets back to what the preferred investor just paid. And what this does is you can use this back solved equity value to then allocate value to the other share classes in the company's capital structure, including common shares, right? Now, I mentioned that the back solve method, it's a form of calibration to a recent transaction, but really the back solve method can also be used as a calibration technique for subsequent valuations as well. So, for example, if we were to receive a company cash flow forecast and we know what the ultimate equity value is from this back solve that we just performed, we can actually back into what the discount rate would need to be to equate the present value of those future cash flows to the company's enterprise value or its equity value, right? So it can be used as you go forward in time, a calibration. You can put a line in the sand to say, look, this recent transaction occurred, it implied an equity value of X, right? You take a company's forecast and you know what that ultimate equity value is, but you're able to solve for that discount rate. And let's say that next valuation that needs to happen, you don't have a preferred financing round, right, that you can back solve to. But you at least have a data point in terms of a discount rate that you can use or calibrate to as you move forward in time, valuing the company's equity securities. So the back solve method is a very powerful tool and is I'd say the most common method utilized to estimate the fair value of a security within a company's capital structure if a recent arm's length transaction has actually occurred. And I'll just put this up on screen here briefly just to show kind of an example of what a back solve could look like here. And what I really want to turn your attention to is kind of with this example is that, these Class A units or Class A shares here, these are the preferred investors, right? This is that recent transaction that just occurred, and the original issue price was at $1, right? And as you see, the value in the model that we're coming up with is $1, right? Well, pretend right now that, we don't know what the actual equity value is. First, as I mentioned, we need to input all the assumptions around the expected term, the volatility, the risk-free rate, and all the liquidation preferences associated with the preferred or any type of catch-up payments or unreturned capital that needs to be paid out before the common shares ultimately receive any upside in the equity, right? So all that needs to be modeled out first, right? If we just plugged in an equity value, let's say at 50 million, right? This class A value would not be $1, right? But what we're able to do by building out all these assumptions is saying, okay, we know that this needs to be $1. That's what they paid for it. It's representative of fair value. What we're able to do is force the model to say, hey, model, give us an equity value that at the end of the day, using this option pricing methodology, would get you back to $1 a share. Again, it implies a value for the other securities within the capital structure. If we assume these Class B units were the common stock, and actually in this case they are, it implies a value of 67 cents for the common. So you're able to actually get to a value of the common based on what was known and paid for the preferred securities. So I wanted to illustrate that example using the backsolve method. I'll briefly touch on the cost approach here, but the cost approach I'd say is typically used for early stage companies with little or no expense history, and it's unable to make a reliable cash flow forecast, right? And the cost approach I'd say is most relevant when the value of a company is primarily in its tangible assets, right? Or it could be in internally developed intangible assets such as technologies or patents, or maybe the IPR&D in progress, right? That's not yet recognized on the company's balance sheet. So for pre-revenue companies that have not yet made significant progress in R&D or product development, or maybe not have a developed product, or, then the cost approach is often the default method. So regarding the application of the cost approach, really the value is determined by estimating the fair value of each individual asset and then subtracting the fair value of its liabilities, right? There could be adjustments for obsolescence or impairment or sunk costs that maybe don't contribute to its current value, right? But ultimately, as the company matures and develops a product or achieves, a level of revenue, that the cost approach may become less relevant than it's typically replaced by an income or market approach. The last valuation method I want to cover here is the venture capital method, which those on the call today might be more familiar with. It's a widely used approach, I'd say, amongst investors to value early stage startups or early stage companies, especially when traditional value methods like the income or market approaches are difficult due to limited financial history. And really at its core, the venture capital method looks to estimate a company's post-money value by working backward from the expected exit value and the investor's required return on that investment, right? So that required return concept. So it's very similar to the income approach utilizing exit multiples. And of course, the market approach, which rely on the use of multiples as well. But the venture capital method is really only as good as your estimation of the company's estimated exit value, right? So once the exit value is estimated, which is typically based on an exit multiple applied to some future revenue or earnings metric, then it's discounted back to today, and you can then calculate the post-money valuation by dividing that exit value by the investor's required rate of return, right? So that gets you your post-money value. And then from there, the pre-money valuation of your company would simply just be that post-money valuation that was determined minus the investor's initial investment. So the last thing I'll cover today is more the equity allocation methods. You might have seen it up on screen with that example I just had, but I wanted to cover off on the various equity allocation methods, which are oftentimes dictated based on the facts and circumstances of the company. So the first one is the option pricing model. Again, alluded to that before. It's one of the most commonly used valuation methods in practice. and is utilized when outcomes are more, I'd say, continuous or uncertain. And what the OPM does is it treats each class of equity as a call option on the company's equity value. And the exercise prices of those options are based on the various liquidation preferences in the company's capital structure. So the OPM, it allocates the value using Black-Scholes calculations, and it considers the rights and the preferences of each share class and utilizes assumptions that were similar to the ones I discussed before. So time to a liquidation event, volatility of equity, right? And a risk-free rate given the risk-neutral framework. I'll touch a little bit on the current value method. The current value method is the method I'd say oftentimes thought of as the true waterfall method. So it simply just takes the equity value as of the date you're looking at it, right? And it allocates that current equity value as if the company were sold that day. And it ultimately it distributes the proceeds according to the liquidation preferences and the conversion rights of each share class. So the other two methods I would say that are shown up on screen, they're less common, but did want to introduce those methods as they use some form of probability weighted assumptions in deriving a value of a security within a company's capital structure. So I wanted to highlight really just a visual depiction to end here today of the difference between that option pricing model and the current value method. And really its overall impact to the allocation of a company's securities. So the OPM models, they model out a range of possible exit values. And then it allocates the value based on the likelihood of each scenario. And it essentially results in I'd say a smoother, more realistic distribution of value across the share classes, especially when there's preferred stock and they have a liquidation preference or some participation rights, right? So as you can see in this example, the Class A units have a liquidation preference of about 190 million. And I'll just show that right over here, that 190 million. And the equity value of the company as of today is that 150 million, right? So it's showing the equity value is less than the liquidation preference. However, value is still being assigned to these Class A1 units and these Class B units, as you can see down here. This equity allocation, they're getting a little over $1 million each, right? And the reason being, the OPM modeled out the range of possible exit values, and it's assuming a time to a liquidation event of 5 years, right? A volatility of around 60% and a risk-free rate, right? So really what it's doing is it's trying to estimate that distribution of possible outcomes, knowing that that company is not being sold today, right? That equity value has potential for growth, right? The volatility of the equity could go down, it could go up, right? But over time, there is that distribution of outcomes. And in certain situations, there will be value assigned to the Class A1 and the B units, right? The next slide here is that current value method that I was discussing, right? So if the equity value is still that 150 million, right? And you were just to take that equity value and allocate it to the securities and the capital structure today, right? Assuming no additional assumptions around volatility or time to a liquidation event, the full value ends up going to the Class A units, right? And the Class A1 and the B units receive nothing. So hopefully this illustrates that the value of a security at any point in time is not the value based on the current equity value on a standalone basis, but rather should take into account all possible future outcomes, considering the volatility of the equity over the expected time to a liquidation event. So just to wrap up today, we covered and explained the purpose of a 409A valuation, when companies might need it, and what are the options around, the safe harbor concept, right, and what it can provide companies. The next is we kind of went through a breakdown or an understanding of the characteristics of early stage companies, as well as kind of the environment today of the venture capital valuation world. We then discussed the common valuation methodologies, the income, the market, the venture capital method, the cost approach, and went through those methods in a bit of detail. And then lastly, wrapped it up with those equity allocation frameworks, hopefully outlining some of the big differences between really that option pricing model and the values that are generated from that in the current value method. And I'll kind of mention with one last thing, within a 409A valuation, right, if the company is not planning to sell, in the near term, right, oftentimes that option pricing methodology is utilized, right? So hopefully this conversation today was helpful, and now I'll open it up to see if there are any questions.
All right. So my name is Michael Howard. I also work with Andrew at CLA, and I'll be administering the questions and reading them off. If you have any questions, please use the Q&A button on your menu. We currently don't have any questions aside from the one I already answered. The recording will be sent to IDEA to IPO, and they will push that recording out after this talk is over. But if anybody has any other questions, please feel free to just put them in the Q&A tab, and I will read them off to Andrew.
Yep, and we will be sending out the slides, as well as we've recorded this presentation as well. So I believe it'll be on the Idea to IPO YouTube channel. Again, just as a talking point here, wanted to maybe go back to one of the initial slides just to show where that CLA Startup Academy is. We found that a lot of our clients have gotten a lot of great use out of this link. Has a number of great videos, very brief videos that are more topic specific. So really hoping that you're able to find some value out of that. If you have any questions around either from an accounting or tax perspective, right? And certainly, if you have any questions, we can connect you to the right individuals within CLA as well.
All right. So just a heads up for Craig and Robert. If you have questions, the way that we're doing it is just type them into the Q&A section. We won't be unmuting anybody. At the moment, we have a couple of questions that come in, and the first one is, can you elaborate on the option pricing model? And Sankurth, if you could maybe be a little bit more specific as to what part of the option pricing model you're interested in, but we could talk a little bit more in detail about that if Andrew, if you'd like to.
Yeah, no, certainly. And really kind of maybe if it's more around kind of the differences or kind of maybe what the actual option pricing model is, I'll kind of try to hit home on some of the key points of the option pricing model. But really that option pricing model, it treats each share class of equity as it's that call option on the company's equity value, right? And so I think really the key concept with that is, well, if you think of an option, right, there's always some strike price associated with that option, right? If you think about it in terms of like issuing stock options to employees, right, you're issuing those stock options with an exercise price equal to the fair market value of the company's common stock, right, as of that date. Well, within this option pricing model, right, the actual exercise price is based on the liquidation preferences in the actual capital structure. So if I go to this page here, right, just to kind of illustrate the concept a bit better, you see that in this case, the Class A preferred units, right, they get this preferred return or unreturned capital, right, of 191st, right? So in terms of kind of what the call option would be, right, for these A1 units that would then come in next, right? They wouldn't be able to participate in the upside or the equity value of the company until that 190 million is ultimately paid, right? And so that's where those Black-Scholes calculations come into play, right? To determine what that incremental call option value ultimately is, right? But that strike price is just set equal to, well, what liquidation preference needs to be paid out before I get any upside, right? And really what it tries to do is, it tries to result in that, I'd say, that smoother, more realistic distribution of value across the share classes, whereas that current value method just simply takes that equity value and puts it through that waterfall, right? So kind of going back to that current value method example here, it just shows that, yes, the entire equity value would just go to these Class A units, right? Whereas this option pricing model, if I go back to this slide here, shows that, look, that equity value will grow over time, right? It could grow, it could go down in certain iterations or certain call them iterations in this case, right? So it's trying to model out what those distribution of outcomes could be using that log normal distribution of outcomes. And so in this case, it's showing, yes, there is some value assigned with the common, right, or these Class B units, right? And so hopefully that helped answer the question.
All right, so we don't have a whole lot of time left, so I'm gonna try to get through some of these questions quickly. These valuations are universal. This question says, what about the Indian market? I've seen a lot of them are from India. So these valuation principles are universal in that they can be used to value any company, but individual countries outside the United States are something that it's not necessarily in our purview. So even though you can use these to value pretty much any company, all the companies have revenue streams and things, they don't necessarily adhere to the exact same way that, like, their preferred stock units are laid out. So that's going to be a little different depending on the country's financial regulations.
Yeah.
And then a question from someone says, do you help in reviewing the model? So Andrew, if you want to talk on, what it
Yeah.
is that a relevant third party does as opposed to somebody doing it internally.
Right. Yeah. So when if you were to engage an independent appraisal, right, to perform a fair market value appraisal, right, and let's say, for example, it's to determine the common stock value, right, to issuing options. Typical information that we would gather, right, would be, obtaining or understanding, I would say, whether there had been a recent transaction that had occurred, right? This kind of helps us frame the approach that we would take to valuing the company at the end of the day, right? But the information that we require, especially, would be, the company's capitalization table, right? Also, hey, if you're looking to issue options, how many options are you looking to actually issue, right? What would the ultimate dilution be on those options that would be issued? And of course, asking and getting a better understanding of what the intentions are of the company, right? So when are you looking to have some type of liquidation event? When do you intend to sell, right? What type of liquidation event are you looking to achieve, right? And understanding, hey, what kind of value are you trying to get out of it at the end of the day, right? And so these are just some things we consider, right? We can review, a model. The company has a valuation that they've been prepared internally, and you want a fresh set of eyes, we can certainly come in and just perform a pretty simple consulting engagement and provide any, thoughts around, hey, these are some things you should potentially consider, right? Even if it's just more for management planning purposes.
Okay, so we have quite a few questions coming through, so I'm just going to pick a few of these that we can talk
Yeah.
on. Can you please explain 3 key factors that are necessary to take company valuation higher, if possible, in priority order?
Yeah. Yeah, I mean, that's a great question. And I'd say for each company it can be different, right? But at the end of the day, the value of a company is based on the value that it can potentially generate in terms of its cash flows, right? Now, understanding for early stage companies, those cash flows could be minimal, right? So oftentimes you're investing in that future, right? What could that look like down the road? So then it comes down to more understanding things like, and I would say most often what investors are looking at is the quality of the management team that's in place, right? And what that roadmap is. And when I've talked with investors, right, that's oftentimes one of the key things they look at is, yes, there are a lot of smart technical people out there that are looking to develop a product or develop a service, right? But do I trust in the people, right? And can these people, take this business idea across the finish line, and reach its ultimate goal? So I'd say, number one, it comes down to that management team, right? And then of course, product market fits a big one. But if you're looking at it more in terms of from a financial perspective and what you can do, especially in today's current environment, I would say that the ability of a company to extend its cash runway is very, very important right now, just given the quantity of investments from outside investors right now is becoming less and less, right? So if you can prove, even at an early stage, that you can manage your cash flow or manage your working capital, keep overhead expenses down, right, and extend that cash runway, right, it can really set yourself apart from a value at this point, right? And then hopefully, of course, the market turns around, in the near future. And I see we have about 3 more minutes. I can maybe take 1 or 2 more, Michael.
Apologies, I was just typing an answer to someone so that way we can give at least a few other people answers. Another one that's a good one here, is one of the goals of getting a valuation early for a startup is to create an attractive stock option pool and price. My question is, how can a pre-revenue company get a credible for the IRS valuation that is then attractive and less tax heavy to early founders and team members?
Yep, that's a great question because at the end of the day, of course, you're looking to issue options at the lowest possible price. And that's how you incentivize your employees. But at the same time, you want to say, hey, look, this is the value of our company. Now, it is a balancing act. And at the end of the day, when you engage an independent third-party appraiser to come in, right, at the end of the day, it's looking at what the facts and circumstances are on the date of the valuation, right? There's a lot of risk, right? There's a lot of risk oftentimes in early stage startups. And so there is this high required rate of return that investors are requiring, right? And so from a value perspective, and depending on the approach that is ultimately utilized, those values might be smaller than what oftentimes the founders or the investors think that the value might be, right? The other thing that I do want to mention, though, is if you put a common share value in front of a potential employee, right? You're granting the stock options. Oftentimes, what the IRS will allow, and depending on the marketability of the company, right? If you're able to go out and sell your shares, which is not often the case, is that the value that is determined for the company is often adjusted for what's called a discount for lack of marketability, right? Well, when founders and companies think of what the value of a company really is, they don't really take that necessarily into account, right? Investors might, depending on how early stage the company is, right? In terms of, well, there is no market for my shares, right? And so they expect this higher rate of return. But if you put that common share value in front of the employee and say, well, I think it should be higher, well, it likely includes some discount for lack of marketability in the value of the shares as well. And that incentivizes, of course, the employee at that lower strike price, right? And so sometimes there can be a disconnect there between the 409A indication and what an investor or what a founder could think of what the common stock value is of the company. And I see we are at time here. I do want to say thank you to everybody for joining today. If you have any questions, again, I'll send out this deck, which will include my information on there. But it's been a pleasure having the opportunity to speak with everyone today, and hope everyone has a great rest of your week. Thank you.